The oil market ended the week with strong momentum as geopolitical risks and steady demand pushed prices higher. Brent crude gained roughly 5% during the week, while WTI also posted solid gains. Investors focused on tensions in the Middle East, seasonal fuel demand, and expectations for global economic growth, all of which helped shape market sentiment. The biggest driver was rising geopolitical uncertainty. Concerns over shipping routes in the Persian Gulf and the possibility of supply disruptions added a risk premium to oil prices. Even without an actual interruption in production, markets tend to react quickly whenever the threat of reduced exports increases. Seasonal demand also supported prices. Summer is one of the busiest travel periods of the year, boosting gasoline, diesel, and jet fuel consumption. Strong refinery activity has kept crude demand healthy and limited downside pressure. Another major focus remains OPEC+. Although the group has gradually increased production, it continues to signal its commitment to maintaining a balanced market. If OPEC adopts a cautious approach in upcoming meetings, oil prices could receive additional support. The US dollar will also play an important role. A stronger dollar usually weighs on commodities because oil becomes more expensive for international buyers. However, if expectations for future interest rate cuts continue to grow, a weaker dollar could provide further support for crude prices. U.S. crude inventory data will be another key market catalyst. Larger than expected inventory declines would suggest stronger demand and could lift prices. On the other hand, unexpected inventory builds may trigger short-term profit-taking. Looking ahead to next week, three scenarios stand out. The most likely scenario is continued geopolitical uncertainty. If tensions remain elevated without a major escalation, Brent crude could trade between $75 and $79 per barrel, supported by the current risk premium and healthy seasonal demand. The second scenario is easing geopolitical tensions. If diplomatic progress reduces market concerns, some of the recent gains could reverse, pulling Brent back toward the $72 to $74 range. The third scenario is an unexpected supply disruption. Any significant interruption to exports or production could quickly push Brent above $80 per barrel as traders price in tighter global supplies. Overall, the oil market enters next week with a cautiously bullish outlook. Demand remains resilient, geopolitical risks continue to support prices, and supply conditions are relatively favorable. However, volatility is expected to remain high. Investors should closely monitor developments in the Middle East, OPEC decisions, U.S. inventory reports, and upcoming economic data. These factors will likely determine whether oil extends its rally or experiences a short-term pullback.